Stop everything. Right now. Put your phone down. Close your tabs. Because what I'm about to tell you isn't another generic market update. This is proof that the system you believed was stable is unraveling before your eyes. Gold? Not just hitting highs. It shattered $5,500 per ounce without hesitation. Silver? It's not merely climbing. Silver's up over 145% this year alone, and it's not stopping. And here's the kicker, the part that should make you lean forward. Some of the most respected voices in precious metals are using a word I never thought I'd hear. Broken. They're saying the market is broken. And if you don't understand the implications, you will be blindsided by what comes next. Before we go deeper, I need you to act fast. If you want updates as they happen, not after the fact, join our WhatsApp group. The link's in the description. That's where the real-time alerts, quick hits, and market-moving insights land first. Also, follow us on X, formerly Twitter. Links below. 10 seconds is all it takes. Do it now, because what comes next is relentless. Here's the latest. But here's the unusual part. This isn't another rally you can dismiss. Experts aren't cheering. They're issuing warnings. Nikki Shields at MKS PAMP, a top authority in precious metals, said something that made me stop. She said, "I would label the precious markets as broken, given unheard of volatility." Broken. That's the exact word. So the question isn't whether gold or silver are rising. They obviously are. The question is why and what it means when the insiders are saying the usual rules no longer apply. There's a clue in the current chaos, one that most investors are missing. And that clue will tell you whether you're positioned to benefit or blindsided. Let me explain. I spoke to a friend this week. Not some influencer or YouTuber, someone immersed in money flows and market mechanics. This is the kind of person who sees the gears turning behind every price. I told him what I was witnessing. Gold accelerating, silver outperforming, platinum and palladium following the surge, base metals and rare earths catching bids. I asked directly, is this real or are we witnessing something artificial? He paused, long enough to make me nervous. When he spoke, it stayed with me. The price is real. The move is real. But the mechanism driving it isn't what most people think. Here's what he meant. Most people see the gold and silver spike and think supply and demand. Miners producing metal, jewelers buying rings, industries needing silver for electronics or solar. Economics 101. But the truth? The current moves are not driven by physical demand. They're being driven by liquidity, speculative flows, and capital searching for safety. Maximilian Toei, CEO of Galena Asset Management, put it clearly. The movement you are seeing in metals today isn't fundamentally about demand. It's driven by a weakening denominator, the dollar. Think about that. Gold isn't rising because gold is suddenly better. It's rising because the currency it's measured against is falling faster than almost anyone expected. The dollar index has tumbled nearly 11% in the past year. In 2025, the US dollar saw one of its worst performances in over 50 years, dropping from 108 to under 96, a collapse by any standard. And here's where it gets striking. When asked about the dollar's decline, President Trump called it great. He said the currency is performing well. Politics aside, here was the takeaway. The people controlling the money aren't worried about its purchasing power. You should be. My friend explained it like this. Dollar weakness isn't just a number, it's a slow-moving wealth transfer. Every percentage the dollar drops. Your savings buy less, your paycheck stretches shorter, your future costs more. For those holding hard assets like gold or silver, that same weakness becomes a tailwind. Dollar falls, metals rise. It's almost mechanical. And that's exactly what we're seeing. Now, some analysts are sounding alarms that the metals markets are detached from reality. Guy Wolf, global head of market analytics at Marks, warned that prices are far from the levels justified by physical demand. Once speculative investors take profits and liquidity dries, the rally could reverse sharply. Does this mean sell everything? That it's all fake? No, detached doesn't mean wrong. It means price is being influenced by flows and psychology, not just fundamentals. It reflects a crisis of confidence. Confidence in the dollar, in government debt, and in the global monetary system. Julia Kandosko from Mind Money put it best. We're seeing accelerated de-dollarization, steady demand from emerging markets, continuous global monetary issuance, U.S. debt concerns, geopolitical tensions, and pressure on central bank independence. Add it all up and you don't get a normal market. You get a market pricing and a fundamental shift in global money perception. Gold is the beneficiary because it's been trusted for thousands of years. Here's the reality. This trend is real, but volatile. My friend emphasized, when speculative flows dominate, reversals can be violent. Not because the thesis is wrong, but because short-term traders play a different game. Some money chasing gold and silver isn't long-term. It's momentum for days, not decades. When they exit, prices can plunge rapidly. Volatility cuts both ways. So what should you do? Don't panic. Don't chase every spike. Don't sit frozen, waiting for a perfect entry. Consider your position size, your timeline, and your goals. Then act intentionally, not emotionally. He added something that reframed my thinking. Winners in these markets don't hit exact tops or bottoms. They understand direction, position correctly, and hold through panic. That's the edge, patience and clarity. Now, here's the clue almost no one sees. It's not just prices, it's market structure. Precious metals markets, particularly silver and platinum, are tiny compared to gold or equity indices. Modest capital inflows create huge swings. Normally, that wouldn't matter, but today, global liquidity is massive. Asset prices have been high for so long. Investors borrow against portfolios, effectively creating new money. When equities and valuations get stretched, liquidity searches for a new home. Metals, base metals, rare earths, not because fundamentals changed, but because liquidity must move. And when liquidity floods small markets, explosive moves happen. They feel detached from reality, but the money is real. The rise is real. Even if it's not supply-demand driven, follow the flows. Because when those flows reverse, the term broken market makes sense. Now that you understand the forces driving gold and silver higher, let's talk about what it means for you. Because seeing the numbers soar is one thing, knowing how to act is another. First, you have to accept a reality most investors ignore. The precious metals market isn't like stocks or bonds. It's smaller, it's more reactive, and it's extremely sensitive to liquidity flows. That means the same money can push prices up or down much faster than you expect. And when flows reverse, the swings can be sharp, unpredictable, and unforgiving. So, what does a smart approach look like? It starts with understanding your position. Don't go all in chasing the top. Don't sit paralyzed thinking you missed the move. Start by defining your goals. Are you hedging against a weak dollar, protecting wealth from inflation, seeking exposure to a market that reacts differently than equities? Your answer changes everything. Here's the framework my friend recommended. He said, the first rule is size. Know how much you can afford to allocate without losing sleep at night. The second rule is flexibility. Hold enough liquidity so you can respond if the market shifts. And the third rule is patience. Let your positions grow while others panic. Now, let's break this down. Scenario 1, the dollar stabilizes. Central banks regain control over inflation, confidence returns, and speculative flows retreat. In that scenario, gold and silver could pull back 30 to 40% or more. Those who bought at the top may feel regret. Those who waited could feel vindicated. That's why size and timing matter. Scenario 2, the dollar weakens gradually but steadily. Metals keep trending higher with occasional pullbacks. Volatility remains elevated, but the general direction is intact. This is the middle path, and in my view, the most likely. Your positions need to be sized for resilience, not maximum gain, but endurance through the swings. Scenario 3, something truly breaks. A sovereign debt crisis, a banking failure, or a sudden currency shock forces emergency measures. In this case, gold could double, silver could triple, and premiums on physical metals could explode. Those who prepared early would be in the strongest position. The difference between preparation and panic becomes painfully clear in these moments. Now let's talk about physical versus paper. This is a debate that confuses most people, but it's simple when you strip it down. Physical gold and silver represent sovereignty. It's tangible, unborrowed, and immune to counterparty risk. Paper exposure, ETFs, futures, or certificates, offers liquidity and ease of access. Both have a role, but they are not interchangeable. Treating them as identical is a mistake that can cost you when the market moves fast. My friend told me a story to illustrate this. During a past period of market stress, the paper price of silver dropped, but premiums on physical coins spiked. Screen watchers thought silver was cheaper. Those trying to buy bars or coins discovered the opposite. Scarcity and premiums skyrocketed. That's what a broken market looks like in practice. Multiple prices for the same asset, depending on where you stand. So, how do you allocate? That depends on your risk tolerance and timeline. Nitish Shah from Wisdom Re suggested 15 to 20% of a portfolio in gold, given current global bond market size. Even modest capital shifts from bonds into gold could drastically impact prices. The gold market simply isn't large enough to absorb sudden inflows without dramatic moves. We might already be witnessing early stages of that reallocation. Now, here's another nuance. Many investors panic when they see volatility, but that's the wrong approach. Volatility is a feature, not a bug. It's how small markets respond to large liquidity inflows. If you understand this, you can use it. When others panic, your patience becomes your advantage. My friend said, those who survive and prosper aren't trying to guess tops or bottoms. They understand the flow, position wisely, and hold while chaos erupts around them. It's also critical to assess your timeline. Precious metals aren't about short-term gratification. They're about protection and opportunity over months and years. That doesn't mean ignoring short-term swings. It It means understanding them, sizing positions accordingly, and avoiding emotional reactions. Next, consider liquidity. Keep enough cash or liquid assets to respond when opportunities or risks emerge. Markets may offer incredible bargains after sudden corrections, but only if you have the ability to act. A position that S too large or a cash buffer that S too small locks you out of opportunity and amplifies stress. Now, think about your exposure in practical terms. If you're primarily focused on paper gold, your risk is tied to market access and counterparty reliability. If you're holding physical, your risk shifts to storage and premiums. Each form has a distinct set of variables that influence how you respond to volatility. Understanding these nuances separates prepared investors from reactive ones. Here's another critical point. Don't try to predict the exact moment of crisis or peak. Most investors fail because they chase perfection. My friend emphasized, the first step is always starting. Establish a base position. Start small if necessary, but start. Avoid being empty-handed if the system encounters turbulence. Once your position is established, don't obsess over every tick. Stop refreshing charts every 10 minutes. Build your life, your skills, your income. Allocate additional resources only when new money becomes available. Obsession turns preparation into panic, and panic drives poor decisions. Now let's examine why this market is different. This isn't just a metals rally, it's a structural shift in global confidence. Lint Tran from excess. Com said, gold is in T rising simply due to anxiety. It S rising because trust in the global monetary and fiscal system is shifting. This isn't a short-lived shock. It's a redefinition of gold's role within the system. Read that again. Repositioning gold's role. This is structural, not speculative. Guy Wolf echoed this. Private investors return to gold as a hedge against currency debasement and geopolitical risk. Gold's rise isn't only about dollar weakness. It reflects a broader erosion of confidence in fiat currencies worldwide. And that's the key. Confidence in paper money is eroding globally. When people lose faith in the measuring stick, they return to what's tangible and trusted, gold and silver. The question for you isn't whether metals are trending. The question is whether you are positioned to benefit, whether your allocations reflect both opportunity and protection, and whether your strategy accounts for the volatility ahead. This is where many investors stumble. They confuse price with value. High prices can reflect a weak currency, not an overvalued metal. So instead of asking if it's too late to buy, ask, what problem am I trying to solve? If you're guarding against currency erosion, the price level is secondary. The real focus is the underlying trend in monetary policy, debt, and confidence. And based on everything we see today, that trend isn't reversing. The dollar continues to weaken, debt levels rise, and money creation persists. The forces that drove gold from $3,000 to $5,500 aren't going away. This is a transition, not a trade. A long-term shift in how wealth is held. Now, let's get practical. You've seen the forces at play, you understand the scenarios, and you know how volatility can work both for and against you. The question is, what do you do next? First, get organized. Take an honest inventory of your finances. How much of your wealth is in hard assets? How much is liquid? What is your timeline for needing access to money? What would trigger a sale? What would make you increase your position? If you cannot answer these questions, clearly you're not investing, you're guessing. And this is a market that punishes guessing. Next, consider the balance between patience and readiness. You cannot control the exact path of prices, but you can control your allocation. Decide what portion of your portfolio is for opportunity and what portion is for protection. That split will depend on your comfort level and your objectives. But the principle is universal. Never put all your eggs in one basket, and never let fear or greed dictate your decisions. This is where real-time information becomes critical. Markets like these move fast. One sudden news event, one liquidity shift, can change everything. That's why being part of a trusted network matters. Join the WhatsApp community. The link is in the description. That's where rapid updates, alerts, and insights land first. Follow us on X as well. When volatility spikes, timing matters. Being first to understand the situation gives you an edge. 10 seconds to join can save weeks of uncertainty. Now, let's talk mindset. The people who thrive in these conditions aren't trying to hit the exact top or bottom. They understand direction, act accordingly, and hold while others panic. Obsession with timing leads to emotional mistakes. Start with a base position, then step away. Build your life, income, and skills, and revisit allocation when new capital is available. Your goal is not perfect entry. Your goal is to not be empty-handed if the system jolts. Physical assets require special attention. Storage, security, and premiums matter. The gap between paper and physical prices widens in stress periods. My friend described it this way. During a past crisis, screen prices of silver fell, but premiums for physical coins rose sharply. Investors relying solely on paper exposure missed the real scarcity signal. Understanding which price matters for your situation is crucial. Screen prices for trading, premiums for stacking physical, both can diverge sharply. Similarly, paper exposure has its purpose. ETFs, futures, and certificates provide liquidity and flexibility, but treat them as separate from physical holdings. One represents sovereignty and certainty. The other represents speed and maneuverability. Knowing the difference prevents panic-driven mistakes when volatility spikes. Let's revisit the scenarios. Scenario 1. Dollar stabilizes, confidence returns, speculative flows retreat, metals pull back 30 to 40%. Scenario 2. Gradual dollar weakening, metals grind higher with corrections, volatility remains elevated but the trend continues. Scenario 3. Crisis strikes, currencies or banks face shock. Gold doubles, silver triples, premiums explode, and only those prepared benefit. You cannot predict the outcome, but you can prepare for all of them. Preparation means diversification of form and timing, physical, paper, liquidity buffers, and clear rules for entry and exit. This approach allows you to weather swings and exploit opportunities without being paralyzed by fear. Next, let's talk about timing and patience. Don't obsess over minor daily moves. Markets like these can spike or drop 5, 10, even 20% in a day. That's not an anomaly. It's how small, liquid-sensitive markets behave under massive inflows. Your advantage comes from understanding the context, not reacting to every candle. Your allocation should be sized so that even if prices fall sharply, you sleep at night. If your metals holdings cause stress or insomnia, your position is too large, your cash buffer too small, or both. Practical sizing and emotional readiness are critical. Now, think about price versus value. High prices can be the symptom of a weakening currency, not an overvalued metal. Instead of asking if it's too late to buy, ask, what problem am I solving? Preserving purchasing power? Hedging against debt expansion? Mitigating geopolitical risk? When you align your actions with objectives rather than short-term price swings, you stay rational. And here's the final consideration. This isn't just about reacting to numbers. It's about understanding a broader shift in global trust and confidence. Confidence in fiat currencies is eroding globally, and precious metals are benefiting. Gold and silver are not merely trending. They were becoming a structural hedge against a monetary framework under stress. Practical steps, summarized. Join the WhatsApp community for real-time updates. Follow X for immediate alerts. Take stock of your allocation across physical, paper, and liquidity. Size positions to your risk tolerance, and step away from obsessive monitoring. Build your life and your resources. Let the market move around you without forcing you into emotional decisions. Remember, this is about preparation, not prediction. You cannot time every peak or trough. You cannot foresee every geopolitical shock. But you can ensure that when chaos hits, you have options, flexibility, and clarity. That's how you survive and thrive in a market labeled broken by insiders. Finally, a note of caution. This information is educational. It's about perspective, understanding market dynamics, and framing your thinking. I'm not telling you to buy or sell. Make decisions based on your situation, your risk tolerance, and, if necessary, a trusted professional advisor. The goal is clarity and readiness, not speculation. So if you've made it this far, act. Build your foundation, position wisely, understand the forces shaping this market, and monitor liquidity and flows. Prepare for volatility. Maintain perspective. Protect your wealth. And recognize the significance of what's happening right now. The market is broken. The dollar is weakening. Confidence is shifting. The only question left is what you do about it. Stay sharp. Stay positioned. And whatever you do, don't blink, because this story isn't ending. It's just beginning. I'll see you in the next update.